Have you ever dreamt of owning your own bank? Well, if you have, stick around because today in the spotlight, Miss Michelle Grant is going to show you how to do just that. Welcome to another edition of Business in Motion, a program that focuses on business and entrepreneurship from an Afro-centered perspective, right here on WMEG online radio in Baltimore, Maryland, the number one station in the nation with the dissemination of valuable information with no hesitation or reservation, but an obligation and dedication to the elevation of your present situation. I'm your host, RGL Biz Coach, and by the end of today's show, you're going to have the 7 keys on how to walk away from a settlement table if you're selling your home with 8 to 12% more money where it needs to be in your pocket. Also, in the second part of this program, Business in Motion, we're going to be featuring in the spotlight Ms. Michelle S. Grant, and she's going to be teaching you about insurance and how you can utilize insurance as an investment vehicle, but most of all, how you can use programs that are available today by major insurance companies to establish your own banking system. So stick around, you're going to enjoy it.
The all-new WMEG Radio.
And welcome back to the final segment of Business in Motion, a program that focuses on business and entrepreneurship from an Afro-centered perspective. Again, I'm your host, RGL Biz Coach, and we have our special guest today, Miss Michelle S. Grant, and we are discussing the insurance business, mainly in the first half of her interview, and in the second half, we're going to continue. I want to get into some other questioning about various types of insurance. So you're still there, Michelle? I hope you are.
Yes, I am.
All right, very good. So anyway, I know the things that you enlightened the audience with was very, very good. I mean, a lot of things I didn't know, and I'm quite sure a lot of my listeners, didn't know. And so, that was very, very good. Very inspiring information, both about some of the programs that are available and also about, the business aspect of it. But
okay.
Yeah. But as we proceed, I want to get into some of the technicalities. Okay, the technicalities of insurance and these annuities and these different programs. First of all, as I was mentioning, when I was bringing you on, I'm thinking back when I was younger, and it seemed like to me that was all I knew was one type of insurance. That was life insurance. You pay your money, and then you die, and when you die, the money is bequeathed to your relative or whomever. Tell us the difference. So let's talk about some of the primary insurance policies. I'm speaking, I know you got term life and there's whole life. Let's talk about term life first, then whole life, and kind of compare and contrast the difference between the two.
Okay. Well, Ronnie, yeah. So like you said, there's 2 different types of insurance. There's term, and then there's what they call permanent, which includes your whole life. Right?
Okay, right.
So in a term policy means exactly it's life insurance that will insure you for a certain amount of time. So you can have a 10-year term, a 20-year term, or a 30-year term, and some of them have a 15-year term also. Okay, and so that means that you're going to pay a certain premium.
Okay.
And that premium usually stays level for a certain amount of face amount.
Okay.
And at the end of that term, it doesn't build any cash value. Mm-hmm. And at the end of that term, you no longer have insurance. Okay. Now, some policies may have like a return of premium.
Okay.
Where you can get all your money back when you at the end of the term. There's some that have that. Some will give you a percentage of your return of premium, and then there's some, but of course there's a premium on that to be able to do that. Mm-hmm. Now, there's some that will just, after the 30-year term, you are no longer you no longer have insurance. Now, most insurance companies will allow you while you in that term if you want it converted to a permanent policy, right?
Okay.
A permanent policy meaning that it's a policy that will last you until your death.
Okay.
And with that, and this is where I encourage people a lot of times, if they'll say, well, you know, I don't have a whole lot of money right now. I'll say, well, okay, let's get you a term policy now, and because you can convert it later to a whole life policy, but we can at least now insure you while you're in good health now.
Right.
See, we're insuring your health. So that means when you want to convert it, there's no proof of insurability.
Okay.
Right? So if I get a 10-year policy, let's say, right? I get a 10-year term, and, you know, I have a young person, they're 20 years old, and they're like, I don't have a whole lot of money. I don't really need insurance. But guess what? You're 20 years old, and you have great health now. Right? Okay? So let's get you something, because now, when you want to go get a permanent policy, we can get you something later. So let's say they get into their 5th year, they got married now, they got a house. You see what I'm saying? They got, you know, they got a baby on the way. They want to get a little bit more insurance. Well, now we can convert that policy into a permanent policy for them. We can convert it into either a whole life policy, or we can do an index universal life policy. You know, something that they can use to go towards their tax-free retirement. So this is a way to, you know, they can get something because the cost of insurance for a term policy is going to be less than it would be for a whole life or index universal life policy.
Okay.
You know, so the difference is the term is for a certain amount of time. Now, one thing I want to add with that, there's some term policies that will give you what you call life benefits.
Okay.
And with life benefits, meaning that if you should become ill, or if you should have if you can't do 2 of your living daily activities, or if you should have a heart attack, cancer, stroke, paralysis, kidney failure, different carriers have different triggers.
Okay.
So you have to look at each carrier and see which one they cover. But it also pays that policy. If you have a $250,000 policy, you can access almost 80% of that policy to go. Because sometimes if you turn around and have a heart attack, well, you may be down for a few months, or if you have a stroke. So you may need to pull some money out of the policy. Even though it's a term policy, you can still pull money from it if one of those events should happen to you.
Okay, so it has some of the term. What you're saying have certain provisions in them that will allow the insured to be able to access some of that cash, even though it's term. Now, okay, but now once you stated like, okay, terms are sold in various increments. Okay, now what was the longest term? Did you say it was 30 years?
30 years.
Okay, so now let's say if the policy has been in existence for 15, and let's say it was a $500,000 policy. Now, and 15 years is gone, and it had that provision so that the insurer could actually capitalize on part of the cash. How do they view that? Is it still, you know, let me slow down a little bit.
Let's say they did, you know, take some of the money, or they used part of their face amount because they had some type of event.
Yes.
Right. They have what they call an actuary, where they look at it and then they will kind of recalculate that. And like I said, every carrier is different as far as the rules, as far as how much insurance they will have left. But you never can take out more than what you have on face amount. So they're going to leave a certain amount of face amount there.
Okay.
And over the years, exactly. So.
Yeah. So it just as time goes on, that face amount it's kind of it's being reduced, is what you're saying. And so if it's like 50% of that term,
the death amount, the death benefit has been reduced.
Okay. Got you. But now what you're saying though with this term, it doesn't have any cash value. And could you explain that?
No,
what that means?
It's no cash value there. No.
Okay, gotcha.
Like I said, unless they have a term policy that has what you call a return of premium,
Okay.
and you get that at the end of the term.
Uh-huh.
You can get part of your money back, but it's not like a regular cash value. You're just getting part of your money that you put in. It's not going to have interest or anything added to it.
Okay. Now, so we got a term down, and let's go to our permanent.
Mm-hmm.
Speak about some of
Okay.
the programs that are available that are considered permanent.
Okay. Now, permanent policy means that you have a policy that will last till your death, will pay out to your death.
Okay.
Now, there's different ways you can pay for a permanent policy. You can pay for it every single year. Some permanent policies may have what you call a 20 pay or a 10 pay, meaning it's paid up in 10 years or
Uh-huh.
paid up in 20 years. And those are different types of whole life policies. So you have a whole life, and in the way a whole life policy, it builds cash in it, and the cash in it is usually guaranteed. There's a certain amount, percentage rate in each policy that they'll pay on a whole life policy. And you can also borrow against that policy if you would like. And there's usually some interest if you want to pay it back. If you don't pay it back,
Uh-huh.
once you pass away, it would just be minus whatever money. So if you have a $100,000 policy and
Yes.
you took out $20,000, well, they will then pay your beneficiaries $80,000.
Okay, well, still not
Okay.
bad. Not bad. And you can carry, it doesn't have to be like an emergency. I mean, it doesn't have to be like a health crisis or anything like that in order for you to access the money, or does it have to be, are these stipulations?
You mean in order to
Yeah,
borrow
like
from your policy?
exactly. Does it have to be that you have a health crisis or something, or you can just do it for any
No.
reason?
The good thing about putting money into an insurance policy, you can borrow from that policy. It's just a matter of filling out a form. It's not like a 401k where
Uh-huh.
you have to have a hardship or you have to tell them that somebody's getting married or somebody died. You don't have to do any of that. That's your policy. But with that being said, there's another type of policy that is even better than
Uh-oh.
a whole life policy.
Talk to us.
Okay, and it's called an indexed universal life policy. And what is great about an indexed universal life policy is that you're able to get part of the market gains in the
Yes.
policy
Yes.
without taking any of the market losses. Okay, and what happens in the indexed universal life policy
Mhm.
is that, so let's say the money you put in, and when you start to take that out,
Mhm.
it's tax free. Because
Okay.
you're putting after tax money into it, and because of the law, there's a section in the IRS code called 7702,
Okay.
and because of that section in the IRS code, it will allow you, when you get paid out money on your insurance policy, it is tax free.
Okay.
Okay.
Right.
Okay, so what happens is, so with a universal life policy, is what I love about those is that, so let's say you have $50,000 in your policy.
Okay.
And what makes the policy so great is because you're getting what you call compound interest, right?
Right.
You're getting compound interest. But if, let's say I wanted to borrow $20,000 out of that 50, okay, I could borrow
Uh-huh.
against that policy, but guess what happens? You're still going to get paid as if that 50 was in there. So it's like that 50 is still compounding, even though I took out $20,000.
So this is now you're talking about an investment. Strictly, this is sound like an investment vehicle.
Right. So let's say if I wanted to turn around and Ronnie, you came to me with an investment deal.
Yes.
Right?
Yeah.
I borrowed from myself. See, this is why we use what we call index universal life policies in becoming your own bank.
Yes.
Right? That's
Yes.
that's a whole nother, let me tell you, I'm not going to get into that because that's a whole nother show. But this
Okay.
is what you use. This is the vehicle you use to become what you call your own private bank. Because of what I just explained to you. Because when you take money out of it, it's still going to compound as if that money was still there.
Now that's amazing to me. I mean, it's like you've taken it out, but it's still compounding like it was there.
Exactly.
And I'll tell you, a question was asked to Albert Einstein, what was his greatest discovery? And, it was not theory of relativity, but it was compound interest. Yes, so this policy is giving you that.
And you know what he said about that? Those who understand it, earn it, and those who don't, pay it.
Right. Very interesting. I like that. If you know what you earn it, if you don't, you pay it. Wow.
Right.
Okay. Very good. Very good. So, index universal life. So it's still this. Okay. The person has insurance, but his building is indexed against. Like typically, are you familiar with what they index these policies against? These investments.
They use S&P 500, NASDAQ. There's several different entities that you can use within that when setting up. So you have to get with a professional that helps them pick the right indice to use. Okay, and you can use 50, and you can break it up. You can do 50% in one or whatever, and that's the importance of. I review with my clients once a year to go over the performance and say, okay, well, you know what, we might want to change some things. We might want to, do something different here. So this is the importance of meeting with your professional once a year to make sure that it's doing and performing the way you want it to perform.
Okay, gotcha. I understand. Yeah, so like you said, it's not just it's not a constant growth. It's because it's indexed. It's kind of based on, as you were saying, what NASDAQ, what those companies
whatever entity that you chose to take advantage of in that policy.
Okay, but I think the key thing that you stated is, and I just want to make sure if I'm not right, correct me, that even if that index, whatever it's indexed against, if it takes a drop, are you affected or you're not affected?
You remain level. You don't take any of the losses. You would just remain level.
That's very interesting.
So
that's very interesting.
If the market took a dive for 10 or 20%, and this is the importance. When I tell people when they have money sitting in a 401k and the market takes a 10% dip, right?
Yeah.
Okay. Well, the market takes another 10% hike. You're not going to be back at even. Right?
Okay.
You're still going to be under. The market would have to do way better in order for you to just get back to even.
Wow.
Right? Because if you took a 10%, you have $100,000, then went down 10%, down you're at 90,000. Right? Well, even if it went up 10%, you're only going to make another 9, so you're at 99. You see what I'm saying? You're still at a loss.
I got you. Okay, another question. Do you have any idea, would you know, how, is there like an average increase or an average appreciation on those policies that you might be aware of? Like, let's say over a 10-year period or a 15-year period or something like that.
Well, what we do is anytime we do an illustration, it goes over the last 20 years.
Okay,
right?
So for 20 years.
And it'll show you what the market has done over the last 20 years and what the average rate has been. Like right now, it's about 8%. Okay, the average over the last 20 years.
Okay. So, okay. Okay.
So, and that's what the illustration is based on.
And the beauty there again is you don't lose, because I know from what I do remember with those insurances, they have to have a certain amount of money on hand to be able to pay out. I'm speaking of the insurance company.
Yeah, so and reserves, exactly, and insurance companies are the richest. I mean, when you go into any major city, you'll see a Transamerica building. A trust building. I mean, that's where the money is.
That's where the money is, and I'm telling you, before I came here, I was living out in San Francisco Bay Area, and I know we used to go to the Transamerica building. They got that one that kind of looks like a pyramid shape. Okay, that's in San Francisco. That used to be amazing. Now, we didn't go there for insurance. They used to have a discotheque. That was why we were going But I can't always think about the Transamerica building. And I always wanted, I would look at it in amazement. It's like, wow, look at this building. Because I think it's it had the most panache of any building that was in the city of San Francisco. And what you're saying is it's based on the way that the insurance companies flow. They make a lot of money. It makes a lot of sense to me because, if you have millions and millions of people who are paying in and they get to invest that money and they pay out, and it's like they're calculating, you know what I'm saying? It's like, okay, more people, we're not going to have as many people who are going to be asking for money or who are going to be dying, and so therefore that money can grow. And that's what's giving that level of protection back to the premium holder.
Well, let me say this to you. The way we're using insurance now, it's wonderful because if you have, if you create a family trust, right?
Yeah.
And everyone makes the trust when they die, you make the trust the beneficiary.
Yes.
Right?
Yes.
So that money goes to that trust, and then the trust dictates how that money is divvied out, how it's spent, when it comes to giving out money to whatever.
Yes.
That's where we can start building generational wealth.
Absolutely.
And transitioning, because life insurance is supposed to be a way of transferring wealth, right?
Yes.
That's what life insurance intent is for. But we tend to think of life insurance as death. We only think of it when someone dies. But our life insurance can increase and better your life with the products that we have now and with the education that is coming forth now. So, other communities knew about this, but the black and brown communities, we didn't know about these things.
Right.
We didn't have these conversations 30, 40 years ago where other people were having these conversations, right?
Yeah.
So now we're kind of a little bit behind the 8 ball, and my mission is to educate our communities. I really love talking to the young people, and I love dealing with my older people too, because, or before they retire, because they need to understand the best way to retire. Because a lot of people retire and still have to work only because they didn't put their money in the right vehicle before they retired.
Right. Absolutely. You got that. You are spot on. And I got one last question here. Let's say if a person out of college, okay, they've been employed now for about 3-4 years. Let's say they're 26 years old, okay, somewhere around there. And they're making decent money. They got student loan. They got to repay student loan. However, they still have a certain level. They got a decent amount of disposable or discretionary income. How would you approach them? What would you offer them? In other words, if you would talk to that person.
Depending on how much discretionary income they have, sometimes I do something like this. I may get them a small permanent policy where they can put money in what's called an IUL. But then I would get them a term policy maybe for $250,000, $500,000, right? Because of the income. Because, see, they're going to have their income is going to increase.
That's right.
But now I got them something to ensure their age, because now they have good health right now, right?
Yes.
Because they can convert that policy later if they would like to. And as they get a family or as they get married, there's enough room in there for them to convert that to something permanent. And then they can, start, getting a bigger IUL where they can start using that for retirement. But when they're that age, I will start off with a small one to have that permanent policy in place so they can start compounding some, but also it depends on their budget, because every person's different.
Yes.
But if they don't have a lot of budget, I'll at least get them, because, you can, at that age, I can get them a $500,000, $1 million policy for like a 30-year term, and they make it not cost them any more than $30 a month.
Get out of here. Wow.
Right?
Yes.
Okay? Right? Okay? So, the younger you are, and as a grandparent and people, instead of buying that baby some Jordans,
yes,
get them in policy. IUL, because their cost of insurance is so low, and because compounding, there's such a big difference. I have an illustration that I show of the earlier you start, the less money you need to finish the race at the same amount of money. You see what I mean?
Yes, I do.
So if you start as early, the earlier you start, the better, the less money you need to put into that policy. Because if you start early, you can put money in that policy, and I can do an illustration. Say, okay, we put this money in, they're 1 year old. I've had policies where they put the money in until they're 18 and put no more money in there, and still, by the time they're 60 or 65, can have $1 million, $2 million at the time of retirement.
Woo.
Okay? So, the importance of starting early, I can't even stress that. Hard enough. The earlier you start, the better off you will be. The better off you will be. And that's the best gift we can really give our kids in our community, is starting them with these types of policies, and to give them a real head start.
Well, I tell you what, it sounds like a winner to me. And I just want to thank you. Time, we sitting at being educated and enjoying ourselves, time just zooms by. I'm looking at it, and I only got a couple more minutes. But again, Michelle, if you just want to give out your contact information for anybody who wants to get hold of you.
My name is Michelle Selena Grant. You can find me on Instagram, Miss Michelle Selena, SALENA, or my other site is Abundant Life Solution on Instagram. My website is www.abundantlifesolution.com. And my phone number is 301-675-7933. And I'm also on Facebook. Michelle Selena Grant.
Very good. And thank you so much for making yourself available to educate the audience here. And all I can say is, it's just been great. So thank you.
Well,
and I will be talking
thank you, Ronnie, for letting me share. This is Life Insurance Awareness Month. And what I would say in closing, if you already have a policy, just give me a call. Let me at least look and see what you have. I can't tell you, I've gone to see people, and they thought they had a life policy, and it was only an accident policy.
Gotcha.
Okay?
All right.
So, okay?
Okay. Well, thank you, and I will talk with you later.
You are very
have
welcome.
a good one. And you got to come back on. You got to come back on.
Take care, everyone.
Okay.
Bye-bye.
Bye-bye. All right. So there you have it. Miss Michelle S. Grant seems to be very knowledgeable about a lot of these vehicles. But anyway, you guys got to make sure that you right back here next week. I've got a person who's going to be coming on talking about how you can get those business lines of credit, and that is within maybe a 6-month time frame, even if you just got marginal or mediocre credit. Just brand new on the scene, a proven process for making it happen. And I do want to remind you again to make sure to go, excuse me, onto YouTube and follow me at businessinmotion.com. Till next week. Have a good one. Ciao, ciao. See ya.